Welcome, everyone, to Banking on Growth. I'm Cassie Taraboletti, Executive Vice President and Chief Operations Officer for Midwestern Securities. Since the beginning of our podcast, we've heard from many industry leaders with insightful information. Today, we're going to turn the tables, and I'll be interviewing Michael Graham on our views on the wealth management forecast for 2024. You're all familiar with Mike, but by way of proper introduction, as a president of Midwestern Securities, Michael Graham has been consulting with community banks for over 20 years, driving cultural change through the implementation of a proactive and accountable sales and service culture. He's an alumnus of Loras College in Dubuque, Iowa, and a practicing certified financial planner with a retail client base of his own. Marrying his experience as a financial advisor and a leader in the financial institution community, Mike has a unique expertise in the community institution and wealth management space. Mike, welcome to Banking on Growth.
Thank you. Glad to be here. Glad to be with you today, Cassie.
All right, we're turning the table, so let's dive in with our first question.
Perfect. Let's go.
Awesome. So, how would you describe the current state of the wealth management landscape as we start 2024?
Yeah, good question. So I think generally optimistic and positive. We're coming off of a very good 2023 for most investors. And as we're looking forward to 2024, there's some positive things that are happening. Inflation is coming down, and that's something that the Fed and the news outlets are watching closely. We're basically at full employment as the U.S. economy, and for corporate America, that's great. The consumers are employed; they're making money, and they keep spending money, and that drives sales growth towards profitability, towards free cash flow, towards dividends that can be distributed to the shareholders. Those are all very positive, healthy, constructive things that are happening. The Fed is still widely expected to lower rates in 2024, giving a little bit more fuel to the economy, spurring more growth. So that's something that's positive that people are looking forward to. Something that, again, the long-term investor can be optimistic and positive about, looking for confidence in their ability to create wealth and outgrow taxation and inflation. At the same time, although there's very positive things happening in the U.S. and there's positive things happening globally, the main driver is population growth. Right? There's more and more people on the planet, and those people want to live westernized lives. They want to eat like Americans eat, to have safety and shelter like Americans have safety and shelter, to have opportunity and security for education, travel, things like that. So there's more and more people on the planet. They want to live more westernized standard of living. So more people buying more drives long-term global growth. I think the long-term investor, long-term being 3 to 5 years plus for time for their money to be invested, has some encouraging tailwinds to, again, make them confident in accomplishing their goals with the right financial planner, with the right financial plan. At the same time, for financial advisors and for community banks, there is so much noise and drama and headlines of the day and the selling of fear and greed and emotion that investors are mixed up. They're mixed up all the time. They're mixed up with tons of 24/7 news cycle that is a bunch of data points that customers don't know how to interpret. Customers don't know, investors, I say customers, I mean investors, don't necessarily know how to separate impactful knowledge and wisdom from data points, emotion, and sound bites. And so financial advisors can add a ton of value here, helping clients understand their situation, help them navigate all of this noise and jargon that's out there to help them accomplish their goals. Cassie, we've both seen these studies. I'm going to be off a little bit here, but since 1926, the U.S. stock market's averaged about 10% a year total return. But the average investor, according to some studies, has averaged about 3.3%. Why is the average investor averaged a third of the index? It's because they don't know how to interpret this noise. They get driven around with the emotion. They're selling, they're selling low and buying high instead of the opposite. So all of these needs and these opportunities are great tailwinds, and these, the media cycle, everybody being plugged in all the time with their smartphone and alerts and phones vibrating, has people on edge, and they need a trusted advisor who can make sense of this and help them navigate it. So generally, it's a great time to be a financial advisor. It's a great time to be a long-term investor in the capital markets with the right long-term strategies.
Awesome. Yeah, I totally agree. Those great insights, Mike. So you've been helping community banks optimize their wealth management divisions for over 20 years now. So what has changed over the last few years to bring us to where we are today, besides the gray in your beard?
That was very polite of you. Yeah, you didn't mention my hairline. I appreciate that. But time marches on. And in that time marching on, in 2004, banks, frankly, weren't as interested in constructive, non-interest income sources, right? In 2004, doing things like offering wealth management to your customer base seemed like bankers thought that was optional. That's great. It's like an ATM. We'll make a little fee off of our ATM, but we're really making our money on the spread, paying less in deposits, charging more in loans, and overdraft fees, right? We're charging people when they bounce checks. And it was optional, and it was progressive, and a lot of banks were interested in non-interest income and fee income that was constructive, like wealth management divisions, like insurance departments, like owning their own accounting firms. Those things were of interest in 2004. Some of them dipped their toes in, some got in and are kicking butt at it and have been very, very successful. But in 2024, those things are not optional anymore. There's been a war on banks coming out of Washington, D.C. There's been a war that's been hot and cold and hot again on what the politicians call junk fees, and coming after these other fee sources like overdraft fees we've seen the last few years. And so those punitive non-interest income sources that banks have had are shrinking, and banks have to, again, it was optional, now it's mandatory, have to be looking for an alignment with their customer base that adds value to their customers, that also drives revenue to the financial institution. So in a very simple concept, 20 years ago, doing these things was an option. In today, doing these things is absolutely mandatory for a financial institution to think that it is meeting its customers' needs in the financial services and doing all it can to maximize value for all stakeholders: shareholders, employees, customers, community.
Got it. I think that's a good tie-in. You brought up some potential regulatory changes within the banking world, and that takes us into our next question. Are there any regulatory changes or updates specific to wealth management services expected in 2024? And maybe even how do the regulatory changes from banking and wealth management combine or intersect, if at all?
Yeah. Important topics. We've had some bank associations on our podcast, in the past, and we had our friend Ballard Cassidy from the Kentucky Bankers Association on here talking about coming back from Washington, D.C. from one of their fly-ins, and talking about how it's just getting harder and harder and more difficult for banks to stay independent. So, I think that it's certainly happening. We've got a very good friend who's a president of a community bank in Illinois, who talks about this. He's saying, I've got to pick the successor for me. I need to identify who's going to be the president of the bank after I retire in 7 or 10 years. And he says, I think we have to break it up into 3 jobs, because when I became the president of the bank, one person could do this and set the tone and hold staff accountable. The magnitude, the intensity of the state regulators, the FDIC, the safety and soundness, the BSAs, the AML audits, right, have all just increased significantly over the last couple of decades, in the time that my friend referring to is the president of the bank. So they're looking at, okay, now we've got to break this up into 3 jobs. Do we have enough people in our community that can fill these 3 jobs, or is there enough people in the bank that want to grow into these? And then we've got to increase our FTE count, our payroll expenses to do that. And how does that impact our profitability? So these things are, death by 1,000 cuts to community banks that are increasing payroll, creating stress on their P&L, and forcing a lot of community banks to think differently about how they position themselves. Specifically, our side of the ledger, wealth management, our biggest risk continues to be avoiding customer confusion and understanding you're on the non-traditional side of the bank. So the regulators are very intense on our side of the space, whether it's the state that we're in, whether it's FINRA for broker-dealer and commission-based business, whether it's SEC for RIA business, registered investment advisor business. Again, there is not a rollback of this. There is a complexity to this that just goes one direction. So it's very important that the community banks have the right partners. Right back to my friend who's the president of the bank, he needs to leverage and outsource partners who can provide expertise navigating both sides, the traditional side of the bank and the non-traditional side of the bank, that can help stay abreast, stay attuned to these things, and make sure that the I's are being dotted, the T's are being crossed in the compliance departments. We see so many community banks that the president is the program manager and also doing all of these other things and making sure payroll goes out and loan committee meetings are taken care of. It's very difficult for them to stay up on the changing regulatory environment and do all of this, let alone to stay up on the changing regulatory environment on the securities side. And they really need to partner with, again, people that they can leverage the relationships and outsource to the right-sized broker-dealer, in our case, or RIA, or corporate trustee for outsourced corporate trustee services as well, so that they don't have to add the FTE to their expenses, and they can still have professional people that are attuned to what are the regulators looking at on this audit cycle, right? Cassie, generally, any questions on that, or is there anything there that you want me to go into more for this topic?
I don't think so. I think you've covered the similarities of the struggles between wealth management and banking. We're all playing in the same field. We understand, right? We're dealing with the same struggles. So no, I think you covered that well. Thank you.
And I think that a lot of this, it's a recurring theme, comes back to having the right team, and the team is your employees. The team is your consultants, compliance consultants. The team is your bond portfolio consultants. The team is your broker dealer. The team is your core processor. The team is your CRM manager, or your program at the bank. You have to leverage these people because the bank presidents, their jobs have tripled over the last 2 decades, and they can't be great at all of these things. We see some banks that we come into that are very successful banks, 7-figure revenue, and the broker dealer has put a lot of compliance work back on the bank instead of the bank offloading the compliance work entirely to the broker-dealer. And the economics aren't there for it. The broker-dealer is paid to do this stuff, to be a part of the team, but without being a fixed expense of the team. And we see some of our competitors, they're a fixed expense. They have to pay the BD to be their Office of Supervisory Jurisdiction, or OSJ, and they're paying the BD an override. So you can do this really well with the right partners and the right relationships, but just like a lot of banks are too big to be connected to the customer, a lot of broker dealers are too big to really be connected to the customer, which is the community bank. Specifically, our regulators continue to focus on, again, beyond the customer confusion, correspondence, tracking texts, archiving texts. Written correspondence has to be reviewed and archived. That's a big change right now. Our regulators continue to heavily scrutinize annuity sales. Annuities seems like always in the crosshairs of the regulators. Community banks need to be aware of that too, that equity indexed annuities specifically, I think, are still the most litigated product in the securities, or in the quote investment world. It's not a security, but quote investment world. And a lot of community banks don't know the risks that they have with some of these equity indexed annuities. And I would start, if I was them, asking, why is it one of the most litigated products that are out there? But these are things that the right broker-dealer should be helping the community banks understand the risk, navigate the risk, and then mitigate the risk through good recruiting, good training, and being small enough to be engaged to supervise those financial advisors in the field. But there's a lot going on. There's a lot to be concerned about, and make sure that we're doing right with the regulatory environment that's out there.
Yeah, you bet. So clients are the core of everything that is done in banking and wealth management. So how are the expectations of wealth management clients within the community bank sector evolving, particularly with the younger clientele?
So I've been in the industry since I got my Series 7 when I was 22 years old, and I'm 50. And when I started in the industry, there was still a lot of quote stockbrokers, right? People that were calling a very transactional business, like a lot of banks mentioning that annuity comment at the end of the regulatory question. There were transactional shops. And so it was transactional full service or transactional discount. And so people became very concerned, how much do I pay for a transaction, a trade? I want to buy 100 shares of this or sell 100 shares of that. The internet really paved the way to access to capital markets and access to cheap research for the retail customer. And that allowed for more competition for trading platforms. People didn't have to be connected to Mother Merrill or, a wirehouse like Morgan Stanley or even Edward Jones to have access to the capital markets. So it became all about how cheap can I do my trade. Discounting was something that was front and center. And then, the kind of ebbs and flows. So you have a decade like 2000 to 2010 where the S&P 500 goes flat for an entire decade, right? Indexers who were getting by on the cheap, maybe, and just being passive investors in the equity markets didn't make any money for an entire decade. So, went from discounting to indexing and cheap trades and market perform to a lost decade of no return on the S&P 500. With that being encapsulating the Great Recession, 08, 09, people seeing the markets basically cut in half in a very short period of time. And then after 09, seeing a great recovery, some flat years, COVID, 21, great year, 22 down year, 23 pretty positive, right? It's all over the place. What that has done though is I think it's conditioned people to not worry about the day-to-day ups, downs. Are we here versus the benchmark? Are we there versus the benchmark? But there's been so much noise and so much movement and so much volatility just in that period of time. We had the dot-com bubble, we had the Great Recession, we had COVID. And people understand that markets go up, down, and sideways. And it's more of a focus for the investors on that all happens. I get it. But am I on target to accomplish my goals? So it's a relationship between the financial advisor. This is where we are now. It's about the relationship between the financial advisor and the client. That's a partnership that has complete transparency. Where are we? Where do we want to go? What's important to us? And then more of a delegation from the client to that trusted advisor to build and manage that plan that keeps the client on task, keeps the client confident that they are goal ready, retirement ready, college funding ready, whatever those things are. And so they can go about living their daily life at their highest level and live that fulfilled life where they are engaged in their work, they are engaged in their family, they are engaged in their travel. And this may come back to more the younger investor who wants to be good at what they do and wants to enjoy the life that they do, that they want, and wants to have that high trust delegated relationship that's about accomplishing their goal, not saving $20 on a trade and not market performing a benchmark. Because we know there's periods of time that market performed the benchmark, like 2000 to 2010, market performed the S&P 500 is terrible, right? You made zero for a decade. So it's not about those short-term things and those pennies. It's about those dollars that keeps those clients, invested and focused on their goal, accomplishing their goals, living that, again, more fulfilled life and peaceful life with confidence that they're going to get where they want to go with that trusted advisor.
Thanks, Mike. So you've talked a lot about over time, technology, the influence of media, and you've talked about the future and anticipation. So given the anticipated market conditions, what investment strategies are community banks considering or recommending to their wealth management clients in 2024?
Our community banks and our financial advisors in community banks have a consistent, professional, disciplined investment strategy throughout our entire footprint. And basically, it starts with knowing your clients, whether it's 2024, 23, 22, 21, et cetera, right? It starts with knowing your clients, knowing what's important to them, and then helping them understand their short-term needs, right? Short-term would be less than a market cycle. So again, a typical market cycle is 3 to 5 years. So short-term is under 3 years. For money that's under 3 years, money should be in cash reserves. It should be in checking, savings, money markets, short-term CDs, what might be called a cash reserve or a restricted reserve. We don't generally want our clients that need that money in less than a market cycle in anything that has marketability, has the ability to fluctuate up or down in value. We want it to be stable, boring, predictable, and be paying a competitive rate to the customer, whether it's an interest rate or a yield on a money market mutual fund. That's short-term money. If our clients have a long-term, which we consider mid to long-term, 3 to 5 years plus, if they have a market cycle or more to go through, and their goal or their lifestyle, what's important to them is to accumulate wealth, to create wealth, to fund college, to fund retirement, to start the business, buy the second home, expand the business, whatever those things are, we want them to be in assets that have the opportunity to create that wealth. And we consider those assets ownership assets, right? Those are owning part of something. So owning part of somebody else's stock in the form of participating in the stock market, whether it's individual securities or mutual funds, whether it's open-end funds, closed ends, ETFs, whatever, owning part of other people's business in the stock market for that long-term ability to create real wealth and outpace taxation and inflation. As we've known, every Ibbotson chart that we've ever seen that contrasts inflation versus treasury bills, bonds, or stocks, the stock market has historically been a very strong wealth creation machine. And we want our clients to be in those ownership assets for long-term money, 3 to 5 years plus. But we don't want to just go in blindly, whether again it's 2020 or 2024. We want to go in always thinking, hey, we've got a market cycle, but if the market goes up, we want to be in a position that we still go up. We participate when things are positive. But we're positioning the portfolio that when things go down, they do, like they did in 2022, that our clients have protections in place. Doesn't mean they never lose money, but we want them generally to lose less than the markets. And the third direction the markets can go is flat. It can go sideways like the S&P did from 2000 to 2010, and the Dow did for the 70s. So we want our clients positioned, again, whether we step into an up market, a down market, a sideways market, that they have the ability to participate if it's good. They have the abilities and protections to protect if it's bad. And if it's flat, we want them to have the ability to be paid to wait and paid to be patient to wait for their assets to appreciate. Getting into that further, Cassie, we want to make sure that our customers are diversified, don't have all their eggs in one basket, right? We want them to be able to shop anywhere in the world that they think there's a value. We want them to be able to be domestic investors and international investors, right? Why do we want to own a company in England versus the U.S. or Ireland versus the U.S. or the Netherlands versus the U.S.? We just don't want to be constricted or limited by borders. We want to be able to buy the best companies wherever they are in the world. So we want to be diversified. We want to be international. We always seek value. We believe what you pay for an investment matters. We don't want our clients to pay too much. So we're looking for leaders of industry that we think are undervalued. And again, if we're wrong, we're typically early. If we're early, we need dividends to be patient and wait for those assets to appreciate. And so we're always looking at how diversified are we? What's our international exposure look like? Are we seeking value? Are we looking for good quality companies that are undervalued? And last but not least, are we getting paid dividends? If we're early, can we be patient? If it's 2000 to 2010 and we're getting a 3% dividend in the S&P 500, or if it's 1926, the Great Depression in 1942, and we're getting a dividend, we can probably be patient as long as we've got our short-term needs covered with our cash reserves, our restricted cash reserves. But if we don't have that cash reserve and we don't have that dividend, it's hard to be patient. So our outlook is always the same, and we're just trying to navigate what we think is out of favor now. What's a good investment to add to our clients' portfolio that complements their diversification, their global exposure, their value, and contributes to their dividend yield?
So things around us change, but the philosophy remains the same. Is that fair?
It's absolutely fair. We have a saying in the office, planning is a process. So the markets are always changing. Our clients' lives are always changing. So we need to be nimble and attentive. We're not timers. We're not trying to time the changes, time the rotations that are short term. We're always thinking long term, and we're always staying true to our principles, but looking for different values in the present and the near future as well.
Right. We spent some time talking about clients. We're going to take it back to the banks and one of my favorite topics, operational challenges. What operational challenges do community banks foresee in delivering wealth management services in 2024?
Sure. So it's really hard to have robust operations without robust people, right? So that's the number one challenge that almost every industry in the U.S. financial services are not a standout here, but it's a pain point that we all have. There's not enough people who want to work in this and want to grow in this and want to make a career out of financial services, banking, investments. There's more demand, there's more work than there's talent flowing into our industry. So that's number one. We have staffing challenges. Almost every community bank that we're talking to has help wanted in some component of the bank. So that's number one. And community bankers can't be on their own with trying to recruit just locally. Who do we know? And I mean, that's great and it's powerful, but they also need to leverage their vendors. They need to network with people like the broker dealer. We help our community bank partners recruit financial advisors. We're on Indeed. We have 2 headhunters that we work with, and we've got searches going on throughout the Midwest as we speak for this. We're also at job fairs. This fall, we were at 2 schools. We were at Loras College, where I graduated from in Dubuque, Iowa, and we were at the University of Illinois in Champaign, Illinois. This year, we're going to be at more than that. But so we've got to be out there. We've got to be very proactive and aggressive, trying to identify good people to come into our bank. So we've got to have that, find good people, give them a path, pay them competitively. And, this ties in so much to this, though. Community banks have to grow. We have to grow into the staffing needs that we have today. We have to grow into the wage requirements that we have today. And that means we have to work on top line growth within these community banks. So we've got to work on providing more services that can be profitable for the banks, that allow them to attract and retain better employees. And, making sure they've got competitive benefits is part of that too. With staffing, it ties in as depth of employees, depth of staff. A lot of community banks, again, the bank president's doing multiple jobs right now. They if they're gone, it's going to take multiple people to replace them, and there may not be that depth. Trust officers, we see a lot of community banks that have the same thing. They have one trust officer and no succession plan, and they don't have anybody in the bank who's trained to, or really anybody in the community that they've identified as somebody they could recruit and train and has a willingness to grow into it. So we have staffing from, we have immediate vacancies. We have staffing from depth. We're going to have vacancies. It all revolves around that. And again, it comes back to community banks have to leverage the power they have. And power they have is the vendors that they have on their team. And the vendors on their team aren't able or willing to be looked at like part of their board, part of their team, part of their staff, then they have the wrong vendor. Right? We want to be in the bank boardrooms. We want to be talking, and we talk to almost every one of our banks every month about how can we help? What are you doing? What are you struggling with? What can we do to help? I was talking with a community banker last week, president of a board, retired bank president. He's, Mike, do you know any headhunters that can help us find an ag lender? So I'm sending emails to my contacts. Hey, do we know anybody who wants to be an ag lender, is willing to move, or do we know of any headhunters? And I'm forwarding those emails to that banker same day, right? It's the chairman of the board of a bank to the president of the broker dealer. We're on their team, right there. We say this and we mean this. There are no bigger champions for community banks than Midwestern Securities. We are on their team. So you got to have those vendors that will help identify, source, filter, train those employees. But I think that's the biggest operational challenge. You've got to have the right people that can walk out the technology, that can walk out the service model, that can show up and make you look good.
All right. That's plenty of challenges to overcome. And you gave solutions along with that. Are there anything else you want to add with how community banks can leverage technology and partnerships to address those operational challenges?
It comes back to scale. Vendors need to, just like community banks can't be just taking deposits and making loans. Vendors can't just be processing trades or buying bonds or installing ATMs or helping with an outsourced tech solution for consumer lending. They just can't do that. We have to work as a team. We have to be collaborative. We have to be able to leverage each other's resources and each other's network. A couple of examples of this, Cassie, are Midwestern Securities. We have Salesforce. Right? We bought Salesforce, and then our advisors are able to use it. And yes, our advisors pay something for that every month as part of a tech fee. Midwestern Securities did the heavy lift. We did the big enterprise purchase and enterprise administration of this. I want to contrast to that. We were talking with a community bank in Iowa about a year and a half ago. They wanted to buy Salesforce. It was $1 million spend for the community bank. It's a pretty decent sized community bank. It was $1 million spend. Our reps What do our reps pay for Salesforce?
It's around $100 a month.
Oh my, right? $1 million spend for a community bank to go alone or partner with Midwestern Securities. There's no fixed upfront expense. There's no contract. That's enterprise lift by Midwestern. And it's super economical for the advisor. That sort of scalable, collaborative partnership. That's what we're on the bank's team. And if your strategic alliances at a bank, your contractual relationships aren't partnerships, they aren't doing these things, revisit them, right? There's too much at risk. It's too competitive of a world, and there's too many pressures, compliance, profit margin, et cetera. You've got to leverage every opportunity, every tool that you have. And Midwestern Securities and vendors need to be considered part of the team.
All right. So plenty of challenges, plenty of solutions. Last call. What other challenges do you see ahead for community banks and their wealth management divisions in 2024?
When we started working with community banks, I think there was over 8,000 charters in the U.S. Now, I believe, I could be wrong, Cassie, but I think that we're talking under 3,000 charters in the U.S. And a lot of deals got postponed last year because of banks' capital positions with the Fed raising rates, pushing bond prices down. It forced a lot of people to say, we're not in a strong enough position. The regulators wouldn't agree we're in a strong enough position to do deals. Deals got paused. Banks wanted to do deals, but they couldn't, or it created too much stress to do deals. I mean by deals, mergers, acquisitions. Now we're talking about the Fed lowering rates a little bit this year. If the Fed, the teeter-totter relationship, rates go down, bond prices go up, banks' capital positions improve, deals are going to get done. We're going to lose a lot of charters in the U.S. this year, next year. We're going to continue to see consolidation, probably at the fastest pace that we've ever seen it in our careers. So that's a challenge. It's a challenge to our industry. It's a dynamic that's out there. The strong will survive, and customers need to be served, right? So it's going to be a challenge. How do you integrate with these deals? How do you make sure that you're providing a high level of service, keeping communities involved in a professional financial services enterprise, having a bank in their community, having an investment firm in their community, having accounting firms in their community, right? We call this creating a financial oasis at Midwestern Securities. Making sure that our financial institutions in these communities are robust is really important. And that's going to be under pressure with these mergers and acquisitions that escalate from here. There's solutions. There's ways to still do that, have those deals be done, make those branches reduce their fixed expenses, reduce some of the risks with depth of the acquired institution, and still have scalable professional services out in the branches, even though there's not a charter there. But it's going to take some navigating, and it's going to take more than we're just merging two banks and figuring out how to create efficiencies with a core process or an auditor, right? It's going to take more creativity. Again, I think making sure that you have the right intellectual capital in your boardroom and on your team, employees and vendor relationships. And then I think, another challenge that's out there, it's always a challenge in everything, just inertia. We have aging boards. I'm in the boardroom of community banks throughout the Midwest regularly, and there's not a lot of young people in those boardrooms. The young people, are at a financial institution that also has their 401k, also has their mutual funds, also has their Roth IRAs, helping their kids with their 529s. They've got more technology. They've got easier ways to visit their money on their smartphones. And so there's not enough of the services that the young folks need to take care of their financial needs, desires, wants. In a lot of the community banks, every state that we're in, there are not enough banks offering more than non-traditional banking services. Okay. So their markets are very, very underserved. And it's a shame because those generations, that's where their money is. It's not in the bank. Right? They have their short-term money in the bank, but their real wealth is in their 401ks and their mutual funds and their 529. So the generation that's coming into leadership needs different products and services that most community banks, most are not providing. And so if they're not in the bank, they're not in the boardroom, and the boardroom is aging, and the leadership is struggling with. They don't have as clear of an alignment with the interests of the generation that is inheriting money and is in their peak earning years and has accumulated most of their wealth in their 401ks. So those are challenges. They've got to get an alignment with the products and services, an alignment into leadership team, an alignment into the boardroom that also has a higher degree of confidence in this current regulatory environment. A lot of these board members that are in these community banks are super successful, super sharp people that when they went on the board, the regulatory environment was totally different than it is now. And the technology environment was totally different, right? Smartphones, I think, have only really been around since 2008. We talk about our internal process and things that we did pre-2008. Well, should we change those? Well, now people are doing it on their smartphone, right? When we set up policies and procedures, there wasn't such a thing as a smartphone. So technology's changed, customer tastes have changed, and you've got to get that innovation and that connection with the technology, the regulatory environment, the products and services in that boardroom. I think that's a really big challenge. And if you can do that, you create a path for that institution to stay privately held, stay an independent charter.
All right, let's wrap it up with a final question. What final insights or recommendations would you offer to community bankers as they enhance their wealth management services in 2024?
Intentionality and engagement are critical. And I don't want to just talk about enhancing. I want to talk about the whole bank. The parting thoughts from me today are the whole bank. You have power. Community bankers, community financial institutions are closer to their customer than Wells Fargo, than B of A, than Chase, you name it. That is incredibly powerful. If community banks can use the power that they have with intentionality, with vision and direction for those things that we talked about, they are extremely difficult to beat. Okay. Community banks have it if they choose it, but a lot of them don't choose it, or they choose to have interest in it, but don't choose to really push for it and don't drive it with the passion that they need to, the passion that they may have in other areas of the bank or that the bank may have had in prior years. So my grandpa Graham used to yell at us grandkids when we'd go in and out of his house. He had a screen door that just slammed shut. And he would yell, "In or out, shut the door." And that's what I would leave as a parting thought for community banks. If you're in it, you need to be in it to win. And if you're not in it to win, M&A activity is going to ramp. Pick the right partner that's a good cultural fit that can complement your strengths and that can bring in the products and services that your community needs after your charter is gone. But there are those deals out there. So in or out, if you're in, be in it. And if you're out, look for the right strategic alliance that can maintain that community financial oasis so your community still has a great place to go for banking services, investment services, etc.
All right. Thanks, Mike. I heard intentionality, drive, and passion. Thanks for sharing all of those things with us today. It was a pleasure interviewing you today. How did it feel with the tables turned?
I really enjoyed it. Yeah, you did a great job. And I love this industry. Right? We love working with community banks. We are small business owners. Community banks generally are also small business owners, and they're very connected with small business owners. This is family. It is David versus Goliath. Customers need financial services. They need it to be professional. They need it to be current, all those things that we spoke about. And I'd rather them get it from us, community financial institutions, then from coastal publicly traded companies that just thinking about next quarter's bottom line.
Very good. Well, thank you, Mike. It was great doing this, and you gave a lot of insight. So thanks, everybody, for joining us on Banking on Growth. This has been another insightful journey with Banking on Growth with Michael Graham and Midwestern Securities, a member of FINRA and SIPC. We appreciate your time. If you found value in today's discussion, consider subscribing for more thought-provoking discussions in the world of finance. Your support helps us continue to bring you quality insights. If you have a topic you'd like us to consider covering or have thoughts on one of our episodes, we'd love to hear it. Just email us at media@midwesternsecurities.com. Remember, the power to grow is within you. Thank you for being a part of the Midwestern Securities community. Until next time, stay inspired and keep banking on growth.